We've been asking this question so many times, as Bob Pisani said, it's often a fake out, and growth always wins the day. Is this time any different?
I don't think there's anything particularly remarkable about the fact that tech stocks were down today. We've been noting that stocks tend to struggle a little bit in the wake of a Fed rate hike. For up to a month after a rate hike, we tend to see choppy or sometimes bearish behavior. And this is just a little bit of shaking out as far as we're concerned. We still see support holding right here.
So are you a buyer on some of the weakness in growth names, technology?
Yeah, we still see names like some of the old guard names, in fact, like your .com horsemen like Microsoft and Cisco still look really strong right here. There's a lot of focus on the FANG names like Facebook and Netflix, but the underperformance in those names isn't new. This has been going on for months for some of those names. So,
Timothy,
yes,
do rates have a direct... Timothy, do rates have... Sorry, excuse me, Elizabeth, for cutting you off there. Timothy, do rates have a direct impact on tech itself, or is it just a question of the sort of general risk sentiment out there?
Well, I think technology companies aren't, unique in their sensitivity to interest rates. It's just simply a lot of the go-go growth companies have been living off a period of really low interest rates. So as cost of capital starts to matter and future earnings prospects matter, then rates will weigh on them. I echo what the other guest said a little bit, in that really bodes well for the older, cheaper tech.
Yeah, I mean, I guess the question is why rates would matter for high-value tech stocks, right? I mean, Tim, a lot of people in a textbook way say, well, growth companies, very long stream of earnings, you have to discount it back with a higher interest rate. I mean, is it as simple as that, or is that just a little bit of an excuse?
In the long run, yeah, Mike, it's as simple as that. In the short run, it's probably a little bit of an excuse. I think some of the high-flying tech companies that are particularly exposed to data have some other reasons, perhaps, that they're selling off. But the switch from growth to value usually has some sort of larger issue at hand, and I'm not sure if interest rates are that issue.
Elizabeth, your thesis that usually the market has trouble digesting a Fed hike, and it's always sort of choppy around that. So this move in Treasury yields, you're not spooked. I guess what's new about it is that we're seeing multi-year highs, highest 10-year yield since 2011, and whether that's the beginning of something bigger, a bigger sell-off that we're going to see in the bond market and the ripple effects across stocks. You don't see that?
At this point, it's not something we're concerned about, no. We still see support levels holding. If you look at the low today for the QQQ, it's right around a trend line that's been connecting some higher lows since April. And we also have been seeing kind of a volume spike for that ETF that was similar to what we saw with the lows in February and April. So we do think it's kind of just a shaking out at this point. We don't think it's anything to panic about for right now, no.